Hi everyone, this is Paul Stewart here. A lot of people are talking to me about the genuinely diverse exempt unit trust and how it can work alongside their existing property portfolios or their existing property development businesses. And the biggest question is, am I too late? I've already got a property development business. So what I'm going to do here is I'm going to look at some real-world tax planning scenarios. None of what you hear is to be taken as tax advice. These are just to give you some things to think about. And I know that we're talking about a genuinely diverse exempt unit trust. A bit of a mouthful. I'm just going to call it a unit trust from now on, if that's okay. So without further ado, let's have a little look. You're never too late. And let's show you how. So you might have an existing UK property company, and you might have an existing project where you're going to convert a commercial into residential or something else. You may also have existing money available inside your property company. That could be refinancing when a project is finished. It may be a loan from yourself or from some other organization. But if you have an existing property development business, the most important thing is that someone needs to look at how the unit trust company and the unit trust structure can actually assist you with regards to UK taxation. And that's where I come in terms of taking a step back and asking the right questions. So let's have a look at the basic setup. So you tell me you've got an existing UK property company. That might be renting property. It might be developing property. Whatever it is, it's an existing taxable business. And if you were to set up a unit trust, that unit trust would end up with its own company that you run and manage, and everything that happens inside that company is tax exempt. So what you've got to do is to work out from this basic setup how these two companies interact with each other. And that's really the crucial part of the conversation before we get started. It's about knowing what can be done and the benefits to you. It might be that there's a scenario in your situation that requires a certain thing to happen. So let's have a look. First thing is simple, straightforward. If you've got an existing UK property company and you have a project and you have refinanced it and you're sat on cash, you could quite easily lend that cash across to the unit trust company, and the unit trust company can spend that money on buying a property and doing whatever it needs to do to that property. And in that case, the only exposure to tax would be the tax payable by your existing company on the loan interest that it's getting paid. Because inside the unit trust company, there's no UK tax. So you've shifted your project from a taxable company right across into a tax-exempt company, and you've done that by straightforward loan between an existing business and the unit trust company. And obviously the loan coming into the unit trust company can come from you personally, or it can come from an existing business. It's really up to you how you fund and finance your property development within the unit trust company. And of course, another scenario is that the unit trust company actually becomes the developer. You may have an existing UK property company with a project in it, and you don't want to upset the existing company in terms of moving things around. So what you do is you have your unit trust company tender for and get the work of doing the conversions and running the project. So your tax-exempt company can make charges and invoice on a commercial basis for providing support services, providing plumbers and carpenters, site management, project management. So all of the things that you were going to pay for anyway are now being paid for inside your unit trust company. And there's a margin of profit that the unit trust company will make on that activity. And obviously you're therefore moving that profit margin away from the existing company across into the tax-exempt unit trust company. So relatively simple situation. You just become the developer inside your tax-exempt company. That then gives the tax-exempt company some money, which is the profit on the deal, which it might be able to use as the deposit on purchasing the next project 100% inside the tax-exempt company. Another scenario is if your unit trust company has acquired a property and you're going to be converting or developing it, then there's nothing wrong with you having an existing UK company acting as the developer. Again, this time what you're doing is you're moving some of the money out of the tax-exempt company across into an existing property development, property management company. And the reason why you might want to do that is you might actually want personal access to income by way of dividends or salary. Another scenario we come across is where people have recently incorporated a property portfolio. They've had the advice, they've moved all of their properties en masse into a brand new limited company, and they're wanting us to help with the tax reduction inside the existing company. As we all know, when you properly incorporate a company, and I'm saying properly quite boldly because there's a lot of issues in the marketplace with incorporations that are not done properly. But if it's done properly, all of those properties inside the existing company can be sold or moved without triggering any capital gains tax because they're all rebased. The tax in terms of property incorporation and value actually sits within the shares of the property company. So what you can do is set up a pension arrangement. And of course, with a pension, contributions are restricted to earnings and contributions get tax relief. But there's absolutely nothing wrong with you setting up a pension scheme and gifting, rather than contributing, all of those properties through the pension into the unit trust company. It's a bit complicated, but it's possible and allowable. And what you've now got here is your property portfolio sat receiving rent, tax exempt, inside the unit trust company, and your UK company pays no more tax because it's not in receipt of any of the rent that's coming in from that portfolio. Again, I'm going through these super quick. I'm not going into the details or talking about any of the tax advice. This is just to give you a flavour of the reasons why we can have conversations with you, even if you have an existing business set up. Now, in summary, everything depends on the details, and that's where I come in, because my job is to actually ask you the questions of what is your scenario. So rather than you presenting me with what you think I need to know, it's actually important that I turn it right round and say, look, these are the things I need to ask you. These are the things that I need to know, because they will have a bearing on the options available to you. So when I say, what's your scenario, I should really say, sit down and let me ask you a lot of questions, because that's where I'll get the right answers to be able to say to you, right, based on what you've told me, these are your options and this is how they may work. And if you would like tax advice on these routes and these options, then that is certainly available. My job here is to ask the right questions to develop out what your scenario is and what your options are, and also to explain them to you. What I'm not doing is formalizing or giving you any tax advice. I'm making life a lot easier for the tax advisors, because they will effectively be brought in if you need them, and they'll know what the scenario is because it's all been laid out neatly in the correct way. So that was a quick run through of existing businesses and how a unit trust company may be able to interact. My name is Paul Stewart. I run Segmented Solutions. We are providers of SSAS pensions in the UK. There's my direct dial number. I also have a digital business card, and the digital business card QR code is up on screen. If you're wanting to establish a SSAS pension, then we have a web page with all of the documents and details and a video explaining how you do that. And again, the link there is on screen. I hope this was of some use. If that whets your appetite, please don't hesitate to go to our website and book yourself a call. There's no cost involved. We'd be more than happy to talk with you. Thank you very much for listening.